The biggest car price bubble we've ever seen has already burst, and now we're being warned that the auto market crash will accelerate even further during the final stretch of 2023. With production going up and dealership lots starting to fill, the conditions that allowed new and used vehicle prices to shoot up are no longer in place as rising supplies finally meet consumer demand. Even some of the biggest Wall Street banks are sounding the alarm about the coming wave of price cuts and how this will impact struggling auto dealers. Recently, they've been coping with a series of financial challenges, including a historical surge in the number of repossessed vehicles due to record loan default rates. Many factors are combining to create a perfect storm for the U.S. car market, and that will likely result in severe financial losses for both auto lenders and buyers this quarter and the next. That's what we're going to discuss today. But before moving on, we'd like to ask you to support our work with a thumbs up. And don't forget to subscribe to our channel so you don't miss our upcoming videos. In a refreshing turn of events, new and used car prices are dropping as dealership lots are being flooded with new supply. Finally, the United States auto market seems to be moving past a very turbulent period for buyers, which was marked by supply shortages and hefty price increases. In fact, data released last month showed that average new vehicle prices faced their largest January to June decline in 10 years. During the first half of the year, the average price of a new vehicle fell by $865, and that's according to a new report from Kelley Blue Book. That number is forecasted to have reached $927 in July, and researchers predict it'll hit $978 by the end of August. Price cuts are expected to accelerate in the third and fourth quarters, meaning that new car prices may see a double-digit decline by December. At the same time, used car prices are already facing double-digit losses. Used vehicle prices are down on average by 16.5% since the start of the year, with monthly declines getting bigger in the second half of 2023. Cox Automotive analysts note that this is the first time that car prices have gone down over an extended period of time since they started the boom when the industry ran into inventory shortages during the COVID period. The researchers described the current trend of falling prices for new and used cars as one of the largest declines in Manheim history and the largest decline since April 2020 when the index plunged 11.4%. In the past 30 days, used car prices fell 6% after dropping 4.2% in June. That represented the largest monthly drop since the early days of the pandemic, when demand collapsed and forced auto dealers to slash prices. Higher interest rates and bigger discounts on new cars are squeezing demand for used vehicles, which is lowering the prices they fetch at auctions dealers used to buy and sell previously owned vehicles. Pricing also is taking a hit because dealers have almost fully replenished inventory on used car lots that were depleted by shutdowns and vehicle shortages during 2021 and 2022. The last several months have followed very closely to 2019's levels, the last normal year we've seen, said Chris Frey, Senior Manager of Economic and Industry Insights at Cox Automotive. A year ago, the industry was looking at transaction prices that were consistently up 10% to 12% year over year. With no inventory in place, it was inflation gone wild. Michelle Krebs, executive analyst at Kelley Blue Book's parent company, Cox Automotive, said in the report, "Right now, the market is moving away from the volatility of that era when a convergence of factors caused prices to surge dramatically, including a shortage of semiconductors, slower manufacturing, near zero loan rates, and stimulus checks boosting consumer demand," explains Cox Automotive chief economist Jonathan Smoke. He said that vehicle prices should see even greater declines over the next 3 months, following large wholesale declines in May, June, and July. The executive highlights that vehicles are depreciating assets, and the circumstances that supported higher prices in the past couple of years have drastically changed. The unique conditions that led to unprecedented appreciation in vehicle values in 2020 and 2021 have been replaced by more normal conditions where demand and supply are more balanced, Smoke added. Noting that retail used prices have dipped for 8 consecutive months, he predicts used vehicles will become more affordable in the second half of 2023 if inflation continues to cool off. Recent trends point to a calmer and more predictable auto market in future months compared to the road traveled in recent years, Smoke stated. Over the last 3 years, demand has often been more than the market could bear, and that's precisely why we had record auto-related inflation, which contributed to the inflation that the Fed has been fighting. But instead of propping up prices, now inflation has everything to do with why used car prices have been going down. That's because consumers have to spend more for everything else, including rent and food, which limits their car buying budget. Carl Brower, executive analyst at IC Cars, stressed during an interview with Newsweek. Used car prices are being driven down by a combination of high interest rates and reduced buying power for consumers, Brower explained. It now costs substantially more to finance a car purchase due to higher interest rates, and inflation is still reducing the average consumer's spending power. For that reason, auto dealers are bracing for more volatility in wholesale price movements through year-end. At the moment, several major automakers are cutting their prices in an attempt to boost sales. According to figures compiled by Axios, in the second quarter, Nissan's average transaction prices fell by $1,244. That's from $36,635 to $35,391. Polestar vehicles have seen an average price cut of $1,558, from $64,057 to $62,499. Meanwhile, Buick prices dropped on average by $1,594, from $39,224 to $37,630. Volkswagen cars are on average $1,934 less expensive. That's going down from $39,473 to $37,539. Fiat's average transaction price sank by $2,201, from $32,730 to $30,529. Mercedes-Benz cars saw an average decline of $2,233, from $84,874 to $82,641. Volvo lowered average car prices by $2,718, from $59,825 to $57,107. Lincoln cut prices by an average of $3,038, from $68,274 to $65,236. Land Rover reported one of the sharpest declines, with vehicles costing $6,882 less on average, from $106,834 to $99,952. Tesla introduced the most extreme price cuts, with electric vehicles costing on average $7,166 less, going down from $62,272 to $55,106. Electric vehicles are the segment of the car market actually seeing the biggest price decline since the start of the year. Industry experts say that the decline in EV prices has been a key driver of the overall industry-wide price crash. The average transaction price for EVs was about $53,400 in June, down from more than $61,000 in January. Kelley Blue Book reports that at the current pace of sales, it would take 103 days for the total inventory of EVs in the US to sell, which is nearly double the supply for new vehicles in general, currently standing at 53 days. A year and a half ago, the supply of new vehicles was just half of what it is today. Although new vehicle prices are still more expensive than they were a year ago, in July 2022, average prices were 12.4% higher than in July 2021. Last month, however, new car prices were just 1.6% higher than a year ago levels. There are two main developments happening at the same time that are helping buyers. Automakers are increasing their incentive spending, and dealerships are agreeing to sell cars with larger discounts off sticker prices. Kelley Blue Book reports that the average incentive spend from manufacturers was $1,928, or 6.2% of the purchase price in July. Incentives can take the form of special financing deals or cash rebates. On top of that, new vehicle inventory was at 2.2 million at the end of last month, which is an increase from 1.75 million in January. But even though buyers are having a greater ability to score a discount at the dealership, that doesn't mean things will get easier for them in the short term. Soaring auto loan rates will continue to suppress demand for the time being. 80% of Americans who finance or lease their vehicle may not experience any relief, given that a 100 basis point rise in interest rates translates into an approximately $20 increase in monthly cost for an average $45,000 72-month loan. This potentially offsets the impact of lower vehicle prices. Problems seem to be aggravating for both auto lenders and buyers in the past few quarters. More Americans are struggling to keep up with their auto loan payments due to rising interest rates and higher everyday expenses. A worrying surge in repossession rates is threatening to spark financial turmoil for lenders and buyers alike. Auto loan delinquency rates tripled over the past 12 months. Subprime auto repossessions are up by 13% so far. Subprime loans are higher-cost loans written to riskier borrowers. They typically default at higher rates than prime loans, and they can be a huge money loss for buyers who may lose their cars but still carry auto loan debt, and for lenders who are coping with tighter credit conditions and elevated default rates. At this point, even prime borrowers are suffering. Their share of vehicle repossessions has doubled. Now that consumers no longer have the benefit of more leniency from lenders and stimulus programs, many may soon find themselves underwater on their loans. When analyzing and forecasting auto loan defaults and repossessions, experts typically consider the unemployment rate and changes in household incomes. During the Great Recession, rising unemployment, falling incomes, and declining home values led to a sharp increase in loan defaults. Unfortunately, a very similar scenario is unfolding right now. BLS reported that in July, the number of full-time jobs plunged by 585,000. It marked the biggest monthly drop since the record COVID crash of 722,000 job losses in November 2020. Home prices are going down at a brisk pace too. Many major cities, including San Francisco, have already seen price corrections of more than 20%. To make things worse, it's estimated that Americans lost 17.5% of their purchasing power in the past 3 years alone, and almost 36% over the past decade. All of this indicates that the U.S. car market crash will intensify from this point on, and conditions will get a whole lot worse before they get better. We hope you have found this informative. Thank you for watching.